Much. While prices for mortgage-backed securities are rising, banks are increasing holdings of the same bonds that led to the financial crisis. Sean Kirk is a distressed mortgage and asset-backed securities trader at Seaport Group. He says the rise in prices is the biggest run-up he's seen in the 15 years he has been trading these securities. Sean, we're welcoming you to the program. Thank you so much.
Judy.
So you say this is just all in all, net-net, a good development, right?
I think it is. You know, what we've effectively done here in the course of the last couple of months is just eliminate the worst case scenario. You know, the rally we've seen is mostly in the secondary market, and now we've seen most of the mortgages that were distressed were probably originated in 2006 and 2007. Now that we have data on that product, it's easier to determine value. And, you know, when I talk about the rally, we've seen that product obviously when it was originated in 2006 and 7 at 100 cents in the dollar. Well, clearly that was too much. And when it went to its lowest point at 30 to 35, that was too low.
If you buy now, though, let's just say at 60 cents on the dollar, what are you going to get?
Oh, first and foremost, I think most of the volatility has kind of been eliminated. We've seen what the worst case scenario looks like. And now that we have 24, 36 months of data on how this product's going to perform, we can kind of see that the Armageddon scenario, instead of being viewed as 50% likelihood, now it's something more like 10 or 15% likelihood, and price is going to respond accordingly.
Sean, when you talk about the worst case scenario, I'm assuming you're talking about prices, because I went back, for example, and looked at a Moody's report on jumbo loans that came out in March, and they said the deteriorating performance of jumbo pools, drop in housing prices, rise in unemployment rate was making them revise their loss estimates. All that stuff has continued to deteriorate, right? So it's just a question of value versus performance here?
Well, it has, but now it's just a lot easier to quantify it. Like the worst case scenario, you could say that no one ever feels like paying a mortgage-backed security again. No one wants to pay their mortgages anymore. Well, now that clearly people are going to pay their mortgages, it's easier to determine that, okay, well, maybe 75% of the people will pay their mortgages back, and we'll have value.
Who's buying? I mean, are they large banks? Are they small banks?
Mostly large banks, hedge funds. There's a lot of private equity that's starting to flow in various forms. I think the only thing that you need now to have a fully repaired market is to have an established repo market, which we don't have at this point.
So you're seeing more sort of traders, not so many buy and hold investors?
In fits and starts, yeah.
Okay. Do you think the market has gotten, excuse me, too crowded? Is that one of the reasons why you think you need the repo, or?
No, well, crowded in terms of the investors?
Yeah, just in terms of investors, brokers.
Well, I think there's plenty of brokers, and I think you're going to see some consolidation in the next 18 to 20 months. Going back, 3 or 4 years ago, there was probably only 4 or 5 strictly distressed traders in the sector. Now there's probably 70 or 80. Well, that's because the mortgage market itself is, if you're in distressed, well, 80% of the market is distressed. So,
Sean, we only have about 30 seconds left, but with the success, let's say, relative success of interest back in these products, do we need the PPIP?
Less so. I mean, I think that's a great product for a great system for 8 or 9 of the money managers who are going to benefit by it. A lot of those 8 or 9 money managers who are going to benefit by it have tremendous capital to begin with. I think what you need is an established repo market, because then you'll have market makers like myself who are willing to participate in the sector. It's the over-the-counter market is really so disjointed. You have hundreds of thousands of CUSIPs and probably only 500 to 1,000 people who know how to evaluate them. You compare that to like a NASDAQ or in any other equity market where you have 2,000 particular bonds, which can be traded by hundreds of thousands of different people. So not enough market makers.
Sean, we thank you very much. Sean Kirk, Seaport Group.